Hi, UBRI Connect, and it's absolutely wonderful to join you for a fireside chat with Professor Campbell Harvey to talk about DeFi and the future of finance, his new book. And there's so much to talk about, Cam, and what a year it's been for DeFi. I sort of say from, mid-2020 to now, it's been the year of living DeFi. So I'm really looking forward to hearing some of your insights and what's been going on in the space, because it's absolutely grown exponentially from stable coins, NFTs, and all of the yield farming and different exciting things that are going on. So let's get started. So welcome, and I'd love you to just introduce yourself to the group and tell us a little bit about how you came to write a book on DeFi and the future of finance and your journey in digital assets.
So just briefly about me, I'm a professor of finance at Duke University. I'm also former president of the American Finance Association. And that's kind of linked to how I got interested in this space. That I was editor of the Journal of Finance, which is the top peer-reviewed journal in my field, for 6 years, and I didn't teach. And when I went back to my teaching, I decided to basically redo the course. We've all had this terrible experience where the professor is using slides that are 10 years old. I didn't want to be that professor. So I was teaching international finance, and part of what I teach is foreign exchange. So I decided at that time to add a module on Bitcoin at the time. And this is in 2013, I'm making this decision. So it was really early in the crypto space. And I didn't know much about it. I'm not a computer scientist, though I've published in computer science, but not in this particular area. So I started to read. Obviously, the Satoshi Nakamoto paper was the first stop. And I read that a number of times and just realized that this was like a Nobel Prize winning paper if we knew who the author or authors actually were. And the deeper I dove into this field, I realized that this was something really big. I prepared a lecture. And in my course, there are 12 two-hour lectures, and one of them was going to be on cryptocurrency and blockchain technology. And again, this course was completely fresh, and this lecture took me probably more time to do than the other 11 combined. And I guess when I presented the material, I was nervous because usually in asset management, international finance, given my publication record, I can field just about any question. And if I can't answer it, I can find the answer pretty quickly. But in this space, I'm relatively new. And there was a chance that I could be asked very difficult questions by, computer scientists in the course. So I was pretty nervous about it. And the lecture, I thought, went okay. And you know how it is in a course where you're at the hour, everybody just gets up and leaves. You have to finish exactly on time because students get very annoyed if even 1 minute you go over. So I finished on time, but in contrast to the usual situation where everybody jumps up and leaves, people just sitting there. And I must have made a mistake on the stop time. But no, it was correct. And people were like in a daze. And I didn't know. I thought maybe I bombed the lecture, but they just came to the front and people said, this is really special. This needs to be a whole course. And that's what it turned into. Actually, right now, it's like 5 courses. And that began my interest. And the course has morphed into something that essentially focuses on decentralized finance. The book is based upon my teaching in decentralized finance, and it's my effort to broaden the audience beyond Duke University and have a bigger impact.
That's an absolutely fascinating story, and congratulations for being so proactive in 2013. One of the things that kind of interested me is that even though, from those early days, we were talking about decentralized technologies, I don't think that the whole term decentralized finance really took off. I first heard it in 2019. And in terms of everyone knowing about it, I think that's a 2020 phenomenon. But, I think it's be really great for the people who are listening for you to just talk us through what is DeFi? Is it crypto? Is it different from crypto? Is it something more, something less? How does it differ from any other kind of finance? Give us some of your definitions.
Yeah, sure. And I think this is really important to understand the foundations. So, for example, Bitcoin is a decentralized protocol. The problem with Bitcoin right now is that it has limited use. So it is a speculative store of value. It's possible to use it as a transaction mechanism, but that involves other technology to be basically bolted on to the Bitcoin blockchain. So decentralized finance is about algorithms that actually reside in a blockchain technology. So Ethereum is by far the leader in terms of their blockchain being used for this. And think of decentralized finance in a very simple way, that you trade in a peer-to-peer way with an algorithm. So you want to buy asset two, you've got asset one, you send asset one to an algorithm, and the algorithm sends you back asset two. So it's not really that far, like in terms of a vision of the future, it's not really that far-fetched that in the future we will be trading or interacting with algorithms. And this is not just finance, but just in general. So decentralized finance allows for this exchange without a thick middle layer of broker or exchange, centralized exchange, and things like that, where all of the trading is being moderated by an algorithm and connecting peers very directly. And then it's not just exchange. It's about savings. It's about lending protocols. It's about tokenization of different assets. You mentioned NFTs, and they've taken off very significantly. But all of this is done in a decentralized way. And the beauty of that is that, again, you take away the middle layer. And when you take away that middle layer, the transactions costs go down very dramatically. There's only a limit to what the current wave of fintech can actually do. This actually is, to me, the end game where peers are actually interacting with peers directly.
And that's actually really powerful if you think about the previous panel that was just streaming, which was talking about financial inclusion, because anyone with a mobile phone can access this and interact with the algorithms. And that's a real game changer. And people talk about the unbanked, but if you've got a mobile phone and you can do this, do you really need a bank account? I don't need you to answer that question because I'm going to ask you another one, but it is a kind of powerful thought, isn't it?
Yeah, no. So again, the previous panel in my book, I talk about the 1.7 billion that are unbanked, and a great example of this is Venezuela, where the country is basically in hyperinflation, a reckless monetary and fiscal policy. And if you're rich in Venezuela, no big deal. You have a bank account in U.S. dollars in Miami. And if you aren't rich, you get hammered by that inflation. So what decentralized finance allows is that those that are not rich have mobile phones, and they can actually have, for example, a US dollar-backed stablecoin on their phone. That's their bank. Their bank is that that mobile device. So they all of a sudden become banked. And effectively, if you put them together with those that are well off, you've effectively disintermediated the central bank of Venezuela. You've created an alternative currency. And indeed, that's what's happening all over the world right now, where the definition of money has changed.
And just following on from that, you've also seen the proportion of the population holding crypto in Afghanistan, for example, rising, and it was recently reported they're up at number 20 in the world. But if you have a look at the data on the proportion of the population that hold crypto, most of the top 20 are all emerging economies. So the value, mobile phone peer-to-peer, is people are voting with their feet about how important this is for them.
Yeah, but I will kind of qualify a couple of things. That is mainly being used for transactional mechanisms and maybe a store of value, like in the Venezuela example, whereas the DeFi space goes well beyond that. So lending, borrowing, decentralized exchange, and widespread tokenization of almost anything. Indeed, my vision of the future, almost everything is tokenized.
So let's, one of the things, of course, with these new and emerging technologies is that it gets the regulators very excited, and you kind of alluded to in the case of Venezuela about this is kind of replacing the central banking function. So we'll come on to that central banking question, but let me ask you the question, because regulators are getting very excited about this. You've got decentralized organizations starting up that are kind of organizations governed by code and run by code. And so the regulators are scratching their heads about who and what to regulate. But from the point of view of, DeFi and risks, are there what are the risks of DeFi?
Yeah, so I devote a substantial portion of my book on the different risks that we face in this particular space. Indeed, any new innovation has risk. So it's not surprising. If you want to eliminate all the risk, then you might as well invest in treasury bills. And that's not too exciting. So there's definite risk. And obviously in the US, the Securities Act of 1933 didn't really talk about cryptocurrency. So you mentioned regulatory risk. That is very extensive risk. It's a special risk. The SEC has basically focused on the big names, like serving a Wells notice to Coinbase. And Coinbase is a centralized company that happens to operate and benefit from a lot of trading of decentralized tokens. So to be clear, sometimes I call them CDeFi, CEDEFI. So it's fairly straightforward to go after them, but to go after a decentralized algorithm that resides on thousands of nodes across the world, it's much more challenging to serve a Wells notice to the algorithm. And even if somehow you shut down the nodes in one country, given the decentralized nature of blockchain technology, it continues to exist in other parts of the world, essentially uninterrupted. So regulatory risk is one of the risks I deal with in great detail. The previous panel talked about Circle, which is a centralized stable coin. Indeed, they have applied to basically get a banking license, a very special type of license. So regulatory risk is a definite risk, but it's only one of many other risks. Perhaps the greatest risk that exists in the space right now is something that's called smart contract risk. So I define this as kind of a new attack vector. And what I mean by that is that if a hacker wants to get into Target and steal some data, well, they have to get into the Target system, and that's really difficult to do. Whereas with these smart contracts that are foundational to decentralized finance, they are completely open source. So anybody, it could be thousands of people looking at the same code, trying to figure out how to exploit it. So the standard of quality for that code needs to be really high. There are companies that specialize in audit, and that's the only thing they do to make sure that that code is secure. But nevertheless, we've seen some pretty spectacular exploits. And these exploits are also really interesting to me because, and this is having to do with decentralized finance being a technology of inclusion. So one thing that you can do in this space is to take out what's known as a flash loan. And think of a flash loan as a loan that you don't need any collateral for, that has a zero duration and no credit risk. And like, how can that happen? So what happens in an Ethereum-like transaction, there could be multiple steps. And the first step is borrow the money. And then you do something with it. And then the last step is to pay it back. The way that decentralized finance works, if there's any problem with any of the steps, then you revert to the state that you began with. So, for example, in the last step, if you couldn't pay back all of the money that you borrowed, then you actually revert to the time before this whole transaction took place. So this allows anybody, and I feature in my course an exploit that happened in the spring, where the first step was somebody borrowing $200 million equivalent in Ether. So you think of that type of exploit, and this is like an arbitrage exploit, so the price of a token on one exchange being different than another exchange. So that type of arbitrage, you can imagine a hedge fund could do, like routinely, but we can't do that. There's no way I can go borrow $200 million for an arbitrage transaction. But with decentralized finance, everybody is equal. So that could be a 15-year-old high school student. She sees the arbitrage opportunity. She borrows the $200 million. There's no credit risk, because if she can't pay it back, then everything reverts to where we are. And indeed, there's no interest rate on this flash loan. So again, this is an example of a risk that exists. It's an exploit, but there are more serious problems with smart contract risks, like a logic error in the smart contract. So this is really early. There will be issues. It is open source, so it's a new attack vector. But this is like an example of some of the challenges in this brand new space. There are many other risks, but maybe those are the big ones right now.
I just want to follow up with a question, because you were talking about, you know, auditing the code, and that there are some companies who specialize in auditing the code. But, you know, if you're a consumer and you want to undertake some of these DeFi activities, and I read frequently people are saying, you know, do your own due diligence, make sure it's a project that's been audited. But there just can't be that many people around the world who are really fit to audit the code. So how do consumers ever find out, you know, whether that code is actually secure before they start interacting with the protocol?
Yeah, so this is how it usually works. So there's a community that launches a protocol. It's usually dominated initially by the developers. So the usual story is that the developers retain control early on with a plan to go decentralized. So, and the reason is pretty clear. If there has to be some fine tuning, you want to do that quickly, and the developers can actually do that. So one thing that's quite common these days is to actually show that you've been audited, or you've been audited by maybe 2 different firms. So that gives the users of the protocol some assurance that somebody has carefully gone over the smart contract to make sure that it's secure. So I think it's unrealistic to expect that the individual users do their own solidity audit. That just is unrealistic, in my opinion. So there has to be some reliance upon these firms that actually are in the space that do the auditing. Also, the reputation of the developers is really important. And then eventually, once the bugs are ironed out, the protocol would go fully decentralized. And then the governance community would be in charge of any changes or fine tuning at that point. So let me emphasize that this is not a risk-free space. So when you actually do some yield farming or just get a rate of return that seems quite high compared to like a savings rate at a commercial bank, this is not without risk. There's still the smart contract risk. And we are, again, less than 1% into this disruption. And you should expect risk. And these events will continue to happen until this technology becomes much more mature. The advantage, of course, being less than 1% into the disruption is that it gives people the opportunity to get in early. So it's the ideal time to actually join this space and to learn it. The other thing is that this space is complicated. So it's much more complicated than other technological breakthroughs in finance, at least. So that actually means that those that invest the time to really understand what's going on have a big advantage over those that have only a knowledge of the basic stuff, like the price of Bitcoin or Elon Musk's tweets on Dogecoin.
Yeah, no, all of those are great points, but it does make it beg the question, how do, I'm going to say, the kind of mum and pop investors get involved, because they're not going to have the time or the capability to be able to know the space. So, and you know, you've raised a whole lot of issues there. So how do people who want to get in early even think about starting to get in? Are there places they can go, put their money safely? I mean, I know this is not a risk-free space, but what's your thinking about that? Because you've just kind of encouraged people to get in early, but it's really risky when you don't quite know how to do it.
Yeah, so I totally agree here. So we need to be very careful. And the number one rule of investing is to understand what you're actually investing in. Okay, so I buy some shares of Apple. I understand what they do, right? I've got an iPhone. I've got a Mac. I've got iTunes. So I understand their business model. I get it. So I invest. So it is very important to make an effort to understand at least the basics. And indeed, that is my book. So my book is written for people that have an interest in finance, but want to learn more about decentralized finance. So that's number one. Number two is that you have to have a diversified portfolio. So it is reckless for somebody to, let's say, take their pension and their 401k, sell everything and buy Ether or Bitcoin. That just doesn't make any sense, even though it might turn out really well ex post. That, in terms of the basic stuff that we know in finance, you don't want to do. So the idea here is to get your toes wet, so to speak, and do something very simple. And that might be, for example, holding a US dollar stable coin and providing liquidity to earn a yield that is much greater than what you would get in a savings account. Yes, there's still risk. You're not going to put all your money there, but put a small amount of money there and just learn how it goes. And don't go for the highest possible yield. If somebody is offering 100%, just ignore that. If it should be less than 10%. And if it's more than 100%, it just screams risk. And do fairly small things and get used to it. Set up a MetaMask wallet, and anybody can do that. And just experiment in a small way, build up your understanding, and then you're ready to take the next step.
So let me ask you another question, because you kind of hear a lot in the crypto DeFi community that this is a hedge against inflation, and everyone's printing money like it's going out of fashion, so this is a really safe place to put your money. What would your response to that be?
So again, you need a diversified portfolio. So I've heard these claims that, oh, well, a crypto, Bitcoin, or Ether is a great inflation hedge. However, the track record is too limited. So the quality data for Bitcoin, maybe 2013, we've never had in that period, in that short period, an inflation episode. So theoretically, it's true that the money supply policy for Bitcoin or Ethereum is not linked to any central bank. That's true. However, we do know that much of the trading that happens in terms of Bitcoin and Ethereum is speculative. And for example, when we saw the sell-off of the stock market in March of 2020, the S&P dropped by 35%. Well, what happened to Bitcoin and Ethereum? It dropped by more than 50%. So that suggests that these cryptos right now very much have correlation with the very things that they're designed to hedge. So be very careful on that. So maybe this is also just because a lot of people are just using cryptos as a gambling mechanism. Maybe that will change in the future. That's number one. Number two, again, you need to have a diversified portfolio. There are other established ways that you can hedge a surge in inflation in the US, at least. For example, having an inflation-linked bond. Or buying real assets. There's other ways to do this, and you shouldn't bet everything on a cryptocurrency. The third thing that I'll mention, and this is very important in the big picture. So governments in developed countries, including the US, have racked up an extraordinary amount of debt. And that debt eventually needs to be paid off. It's a basic rule of finance. We like to ignore it, but everybody realizes that there has to be a payoff. And there's three ways to pay off. So number one is to raise taxes, which nobody wants. And we know that raising taxes is toxic for growth. Another is just to print money. And we see how that turns out. And I already mentioned the Venezuelan example of that strategy. So it just creates inflation, maybe not a hyperinflation, but inflation is a tax, and it's a regressive tax. The third way is growth. So you can keep the tax rates the same, but if you're growing at a fast rate, then that actually allows for more revenue to come in to pay off that debt. And decentralized finance really speaks to this growth. And let me give you an example. We talked previously about the unbanked 1.7 billion people. Well, in my opinion, we don't have hard data on this, but more than 1.7 billion are underbanked. And by underbanked, this is what I mean. You've got an entrepreneur that's got a bank account, got a great idea. They go to their bank and say, hey, I've got this great idea. It's going to generate a return on investment of 24% a year. And the bank looks at them and said, well, I like your idea, but we would prefer to deal with one large customer rather than 100 just like you. So given you're a customer, here's the credit card that you've got. And what we'll do is increase the credit limit to accommodate the money that you actually need. So we all know what that interest rate is on credit card lending. An extraordinary amount of entrepreneurial financing happens via credit card lending. So the credit card rate could be 24%, which wipes out the idea. And the idea of decentralized finance is that sort of interest rate is completely unreasonable. It has to do with all of the middle layers of brick and mortar, back office, the profit motive for the bank. If we could have a different system whereby the loan rate didn't reflect all of these other costs, then that project would be undertaken. So the underbanked become fully banked within the DeFi environment. And this project is pursued. And this is precisely the kind of project that spurs economic growth. And is very much related to my academic research on this, where I do have evidence like this, that when you reduce these financial frictions, which means a borrowing rate that is too high, a savings rate that's too low, and just the cost of doing transactions. When you reduce those frictions, it is a positive thing for economic growth. So we've been stuck in the US.
Yeah, no, we're kind of starting to run short of time, but I really want to cover a couple of topics before we finish, and just taking that one on. So just help people understand then how DeFi and tokenization can help entrepreneurs raise money so that they can, pursue these projects that would be difficult to do with the traditional banking. And then I'll come on and I want to ask you a couple of questions about traditional banking. But if you could just clarify that for people, that would be great.
Yeah. So there's so many different dimensions here. So you can think in the future that right now we've got the situation where certain companies raise equity, but it's not public equity. After some point, you do an IPO, and then regular investors can actually access. So there was like an active market amongst very rich investors for, let's say, Facebook stock before it actually IPO'd. So think of a different world where we get rid of the stock certificates, we get rid of the 2-day settlement. So when you buy a stock, it takes 2 days to transfer the ownership to your name. So think of, instead of issuing these certificates, you issue tokens. And when you do that, again, you can think of this as a straight exchange of what we've got right now in the public markets for a token, which increases the efficiency very dramatically. In DeFi, the execution of a trade and the settlement of a trade are identical. There's no delay. So that makes things much more efficient. But also, let's think beyond that, where you actually have equity that is private equity. And I believe in the future, be no distinction between this private and public. It'll just be a token. And anybody can buy that token. You could buy a fraction of 1,000th of a share, no problem. So this allows an alternative mechanism for firms to actually access markets. That's on the equity side. On the fixed income side or the loan side, we will see a robust growth in essentially a different style of peer-to-peer lending. So let me be clear, peer-to-peer lending has existed for a number of years, but is very expensive. Indeed, crowdfunding of equity has existed for a number of years, but the cost is enormous, like 10%. So what DeFi will do is essentially everybody's up here. So it doesn't matter if you're 100 times the size of somebody else, or it doesn't matter if you're just a regular person or a banker. Everybody is the same. And we will have these decentralized pools of loans where people can actually invest in these loans, make an extra rate of return that they can't get today because the banks do that, right? And it's a very narrow market. So what I'm talking about is reducing the frictions, democratizing finance, making this a technology of inclusion, and essentially, when you reduce those financial frictions, it allows ideas to be pursued. Right now, there are constraints on pursuing those ideas. So again, I'm very positive. I was saying that we're stuck in 2% real economic growth, and Europe is like 1%, Japan is 0. And I blame the financial constraints for a large part of that. So I don't think it's unreasonable when we reduce those transactions costs, when we reduce the financial frictions, when we allow all good ideas to be pursued, that we can see much more substantial growth. And I'm talking 5 to 10%, which we haven't seen in a century. So I believe
So,
this is all possible.
you see this as a real economic growth enabler. So I'm going to push you a little bit because I want two more things and we're going to have to finish. So one is sort of where you see this going in the future, but that's the last one. But, what about the banks? Because we're talking about all of this disruption to their business, eating into their profits. They're kind of big and omnipresent. So what this war between traditional finance and decentralized finance, how's it going to play out? What are the banks going to do with all of this?
Okay, so let me address the banks, but first let me address an equivalent traditional institution, and those are the stock exchanges or just the exchanges, because it's linked. And I already talked about the tokenization of equity. And if you think about the way we operate today, you need to choose the exchange that you list on. Whereas in decentralized finance, you could have thousands of tokens trading on thousands of exchanges. So there's a competition amongst the different exchanges. And before the pandemic, I was invited to talk to one of the world's leading exchange groups. And I went to this meeting. It was very interesting. The agenda was very vague. They wanted me to talk about some, crypto, but there was no particular agenda. And when I got there, they had assembled their board of directors and all of their senior management. I sat at a large table and they said, "We only have one question for you. How long do we have?" So it was clear to me that they fully understood what decentralized exchange or DEX was actually going to do. So this is, very clear to them. And I think it's also clear to the banks that it's just a matter of time for them. So they can use some of the techniques of fintech to reduce costs. They can definitely do that. But there's a limit to what they can actually do within their particular architecture. So in the future, I believe in 15 years, looking at the financial landscape, it will be unrecognizable compared to today. I believe that some of these banks will survive, but they'll have a completely different business model and likely be much smaller. So the current banking system is highly concentrated, which means they've got a lot of market power. It means they don't need that business for the very small entrepreneur. It means that the loan rates can be high, the savings rates can be low. All of that will change. So kind of the low-hanging fruit for this disruption is our current banking system, the exchanges, the insurance companies. Look, frankly, nothing has substantially changed in these sectors in over 100 years, which is very striking. The same names, the same basic infrastructure. Yeah, there's some digitization, but that's not very secure anyways. So I believe that, again, the system of lending and borrowing, savings, all of this will be much different and much better, much more democratic, much more efficient, and much more friendly to innovation in the future.
So look, just in the last few minutes that we've got, and this has been such a fascinating conversation, and I'd love to talk with you so many more times, but we've just got a few minutes left. So you've been saying, continuously through the conversation, we're 1% into this disruption. So how do you see this playing out? Like, give us a vision for the future of finance.
Sure. So the future of finance, and it's not a surprise I'm going to say this, will be decentralized. And the first sentence in my book is we have come full circle. And what I mean by that is when we started market exchange millennia ago, we had to use barter. And barter really inefficient. So you had to have an exact match. And that's why money was introduced. So with the money, there was it was a medium of exchange, and it made markets vastly more efficient. However, we've come to the point with tokenization that we can think of money differently. Indeed, we can think of a return to barter, where my wallet has got a number of tokens, and some of them could be backed by real assets like gold. And then I choose how to pay. And if there isn't a match, so let's say I want to pay in gold for my groceries at Whole Foods, and they don't want gold, it's not a problem because instantly and seamlessly in a decentralized exchange, I swap my token for what the grocery store actually wants. It happens instantly. So this is a completely different world where you've got much more efficient exchange. You've got a different sense of what money actually is. And I know we don't have time to talk about central banks, but effectively, the central banks have already lost control of the money supply. They know it. They're scrambling. They'll try to slow us down, but they're going to fail because the horse has left the barn already. So in exchange, this will happen. And then, of course, financing, whether it be traditional loans, mortgages, or savings account, that'll be handled by decentralized finance. And again, this idea of tokenizing everything, we're seeing just the beginning of this with art, and just see what that's actually doing to this particular area that's been underserviced for so many years by very powerful middle people. When you put the control back to the artist, then that will lead to the field flourishing. So I believe finance will look much different in the future. We will have assets that we can invest in that we don't have today. So new assets, our portfolios will be much more diversified. Everything will be paid in real time. You use something, you pay for it in real time. None of these subscriptions where you got to pay monthly or annually, you pay for what you use. There will be millions of blockchains all connected. It's a very exciting vision of the future.
Okay, I got to stop you there. Professor Cam Harvey, you are absolutely awesome. What an exciting conversation. Everyone's going to be buying your book, and we'll just follow this with great interest. Thank you so much, and I'm so sorry to stop. Great speaking with you.
Great questions. Thank you very much.